All right, we are back for another Friday financial wrap-up without Mr. Michael Zuber. Michael is on a well-deserved vacation. He's having a great time. It's Black Friday today, so I'm going to do the daily financial news solo. Welcome the One Real at a Time community. This is for today is Black Friday, November the 24th, 2023. A couple things we're going to talk about. We're going to talk about retailers. We're also going to talk about the National Association of Realtors. They posted existing home sales. Michael talked about that earlier in the week. We'll talk about mortgage rates. We'll talk about the Fed. And then we'll also talk about what to expect in terms going forward. Also the VA, the Veterans Administration, had some really good news this week as well. So let's get right into it. Retail sales, what's going on there? Well, a couple of things. Lowe's, the home improvement store, they cut expectations. What does that mean? They're letting their stock investors know, hey, we're probably not going to hit the same kind of profitability, the same kind of revenue growth that they've had previous. And why? It comes down to one simple thing. Michael's been talking about it for a long time. The consumer is slowing down. People are just not spending as much money in home improvement. Consumers are starting to tighten up. Also, Best Buy posted, they talked about this week that the consumer, they're basically hunting for deals. Meaning that, you've got people now today that when they're shopping, even on Black Friday, even beyond that consumers are looking, deal hunters, people that are looking for better bargains. We talked about last week too, people like stores like TJ Maxx and Ross and Marshalls and things like that doing better. Why? Because people are shopping for bargains. So what does it mean? It means the consumer is slowing down. Also, even in high-end sales, Nordstrom this week, they reported that sales are down 7% year over year. And they also talked about soft foot traffic, meaning there's just not as many people in the stores. Time will tell. We'll see. The consumer ultimately is slowing down. Michael's been talking about that for weeks and weeks and months. And then also something Michael said in the daily financial news this week, that we're probably not going to be in negative GDP for Q4, the quarter we're in now, but probably to expect the recession to hit next year in Q1 and Q2. Why? Because these are lagging indicators. These kind of give us an idea, a direction of the economy, but it probably won't show up until Q1 and Q2. So time will tell. Let's continue. Let's continue moving on. The National Association of Realtors this week, they reported adjusted annual rate sales of 3.79 million. Now, to give you an idea, Michael nailed it. He had predicted 3.8 million. And what does that mean? That means annualized sales. That's the pace that we're on for annualized sales. So to give you an idea, 2 years ago, even 3 years ago, we were well above 6 million sales, okay? 6 million annualized sales of existing resale homes. So clearly, real estate is slowing down. I think we all know that. That's not a surprise. But this is actually good news. Why? Because we're probably at a bottom for transactions, meaning that this is probably, we're in the trough or we're in the bottom, that transactions will probably begin to improve from here. Also, we'll talk about mortgage rates. Mortgage rates have continued to improve. We'll talk more about that, but tie it into how does that maybe loosen up inventory? We're probably at a bottom. But again, National Association of Realtors also posted that national sales slumped 14.6%. But here's the interesting thing. They said that overall active inventory is still down 5+%. So what does that mean? We're still low inventory. Why? Because most of the people out there that have homes, if they're not free and clear, they probably have interest rates that are 2 and 3 and 4 and 5%. So the reality is that, it's still going to be a low inventory market going into 2024. And then let's transition and talk about mortgage rates. Now, per the Mortgage News Daily, the average 30-year fixed mortgage closed out this week at 7.3%. Now, that's coming down. We were just at 8% just a little over a month ago. So rates clearly are moving the right direction, not because the Fed is going to cut rates. We'll talk about that in a minute, or will they, won't they? We don't think they're going to cut rates. But the real thing is that now mortgage companies now feel like we have some stability, and that now we've basically hit the peak rate, terminal rate for Fed funds, and we're probably now from here just going to slow down, and what would be a Fed pause we'll talk more about. Also, the 10-year Treasury note hit a 2-month low this week at 4.4%. Now, we've talked about this before on the show, Michael's talked about it for years, that the 30-year mortgage typically trends off of the 10-year mortgage, off the 10-year Treasury, 30-year mortgage trends off of the 10-year Treasury. So what does that mean? Well, the Treasury is basically closing out somewhere about 4.4 plus or minus. And traditionally, mortgage companies, rates are typically a margin is typically about 1.7, on average about 1.8% above the 10-year Treasury. So when the 10-year Treasury drops, mortgage rates drop. When it goes up, mortgage rates go up. Okay, so, and again, it's not hand in hand and it's not exact, but they typically trend together, and that is a good indicator, the 10-year Treasury. Now, what's going on is that now mortgage companies are now beginning to do what's called margin compression. So that's what we're seeing. It's because now we have stability. Obviously, the 10-year Treasury is coming down 4.4%. We are going to see rates continue to trend down. And this is interesting, but Michael talked about, there's probably a psychological magic threshold number for the general public that when we hit probably sub 7%, we're probably going to see the market get really wild again. Meaning potentially multiple offers on high demand properties. That's probably, so if let's look at it this way, 6.99, 6.89, 6.95. Also, the hope is that when we do go sub 7, that in fact, it'll even get some people off the sidelines. That there are people out there maybe with a 5.5% or a 5% mortgage or a 6% mortgage that would even be willing to take a higher rate, but because they have a lot of equity and they're able to trade up and maybe get that forever home, or, again, maybe they're, leaving California, going to Texas, going to, other parts of the country, retiring, things of that nature. So, again, the psychological threshold we believe is going to probably be about 7%. Anything sub 7, the market we believe will start to really kind of loosen up, if you will, meaning hopefully more inventory, but for sure more buyer demand, buyers getting basically off the fence and getting decisive and getting more active to look for homes. So I think that's something to really keep an eye on. So we're at 7.3 right now. The real question is, Michael Zuber called for sub 7 for February. He called this, I feel like about 6-8 weeks ago. So do we go sub 7 in December? Maybe, maybe not. Does it happen in January? I think it's very likely it could happen in January. So for realtors, for investors, especially too, if you're a fix and flipper and you're finishing a project, I think it behooves you to really get that project done. And if you can bring it in early, ideally you get that good timing of, the rates dropping, all of that good news and the momentum to maybe catch it early in, maybe in late in December, middle of December, potentially maybe mid-January, early February. But again, it feels like we're headed for sub 7 rates. So let's continue. Wall Street, a lot of talk. They expect that the Fed's going to cut federal rate funds 4 times next year. One of the things Michael didn't believe it was going to be 4. They've been wrong before. Michael was under the impression that, hey, they've been wrong before, they'll probably be wrong again. And that based on the Fed minutes that were released this week, which is kind of the notes of their meeting, things that were said, zero talk about cutting rates. And again, the mantra seems to feel like for the Fed rate funds, higher for longer. Higher for longer. So yes, if we see a recession, if we get into Q2, Q3, and we see a recession, then maybe the Fed starts to loosen up, starts to cut rates. If we see an unemployment spike, yes, then potentially the Fed could, adjust federal fund rates, which again will just create kind of a rapid decline in rates. But even then, for real estate professionals, for investors, we can expect rates to begin to soften up just based on the fact that we've hit terminal rate and we're now seeing that margin compression between the 10-year Treasury note rate and what 30-year mortgage rates are. So let's continue and just look at now, probably a big piece of news and something that's talked a lot about is foreclosures. So the VA this week, last week they were talking about there was problems, veterans were getting foreclosed on or under the threat of foreclosure. I'm actually working with a veteran who's got a loan in default and scheduled for a trustee sale. So where we're doing a short sale. Well, good news, the VA came out this week and said that they are going to halt all foreclosures until May 31st, 2024, and that potentially really looking at their guidelines for loan modifications, for forbearances, and or really just standardizing the process with servicers and with their standards and guidelines. So, it's nice to see that the VA is moving quickly. That was something that, a lot of people were uncertain what's going to happen next. So it's a short week this week, folks. Happy Black Friday. A lot going on. So I hope you had a happy Thanksgiving. I hope you enjoy the rest of your 4-day weekend. Thank you for watching. By the way, Michael did sell out the February event, the big event for 50,000 plus subscribers. So again, if you like the show, please subscribe, like, comment, follow. We really appreciate the support of the channel, one rental at a time here on YouTube. If you're watching this on another platform, Facebook or otherwise, please go to YouTube, one rental at a time. Please subscribe, follow. And he also hinted that he may formalize and actually do a virtual ticket. So watch for that in the next couple of weeks, potentially a virtual ticket for the February event where you can watch at home. That's obviously going to be an opportunity. And then he also talked about potentially releasing another set of tickets. He was going to talk with the venue and see if that was possible. So thank you so much for watching and your support. Have a great rest of your weekend.